Low rates aren't magic. Stocks may be overvalued even with today's low interest rates. Well, yeah. Today's low interest rates justify above average price earning ratios. That's the theory anyway. Unfortunately, that theory doesn't hold up when you look at it through the lens of history. The S&P 500's current PE ratio is well above its long-term average. It is 21.8. When calculated using trailing as reported earnings, or are 39% higher than the average since 1871 of 15.7. Absent mitigating factors, it is difficult to avoid conclusion that the stock market is significantly overvalued. Many think low interest rates are one such mitigating factor. Perhaps the best known argument for this view is the so-called Fed model, which became popular in the late 1900s. According to it, the stock market is undervalued whenever equities earnings yield, the inverse of the PE ratio, is higher than the yield on the 10-year Treasury. The Fed model is bullish right now, since the S&P's earning yield is 2.6 percentage points above the 10-year Treasury yield, which is 4.6% versus the 2% Treasury yield. History provides precious little support for the model. Over the past 150 years, the earnings yield by itself has a better record when predicting the stock market's subsequent return than does the earnings yield that has been adjusted by prevailing interest rates. Consider a statistic known as the R-squared, which measures the degree to which one data series, in this case the year earnings yield, explains or predicts another, which is the stock market's subsequent real or inflation-adjusted return. Possible R-squared readings range from 0 to 100%, with the former meaning the indicator has no explanatory ability and the latter indicating complete predictability. When predicting the market's return over the subsequent decade, the R-squared for the unadjusted earnings yield is 24%. Upon adjusting that yield by the 10-year Treasury yield, the R-squared drops to 10%. The same result emerges when focusing on the cyclically adjusted PE ratio, CAPE. Made famous by Yale University finance professor and Nobel laureate Robert Shiller. CAPE divides the S&P 500's current level by the average of 10 years of earning adjusted for inflation. The R-squared for the CAPE earnings yield by itself is 33%. It drops to 17% when adjusted to the CAPE's yield by that of the 10-year Treasury. The Fed model fares no better when focusing on predicting the market's subsequent 12-month return. But R-squareds are lower at the 1-year horizon, reflecting the greater role luck plays over short periods. The R-squared over the earnings yield drops to 1.5% from 1.6% when adjusting for interest rates. For the CAPE yield, the R-squared drops to 4.9% from 5.3%. To be sure, these results emerge when we automatically assume that lower interest rates are always better for the stock market. Researchers over the years have explored more sophisticated models based on a more nuanced relationship between interest rates and PE ratios, and some of the models have shown promise. However, these models still suggest that the current stock market is overvalued. One such model was proposed in a 2017 article in a Journal of Portfolio Management by Research Affiliates founder Robert Arnott and several colleagues. They found PE ratios tend to be lower when inflation-adjusted interest rates are too high or too low. The sweet spot as far as PE ratios are concerned is when real rates are between 3 and 4%. Since real rates are now below 1%, Mr. Arnott's research provides no support for the above-average current PE ratio. If today's low interest rates should automatically translate into higher PE ratios, Mr. Arnott says in an email, then why don't negative interest rates in Europe and Japan justify even higher valuation levels than in the US?